Welcome to the Explainer. So, if you've been glancing at your investment apps lately, you've probably felt that sudden sinking knot in your stomach, right? We're looking at some intense turbulence on Wall Street, the kind of dramatic market action that sends those little red notifications pinging on your phone and gets everyone whispering the word crash. But hey, let's take a deep breath. Today, we're not just going to stare at falling charts. We're going to put on our financial meteorologist hats. We'll break down the exact anatomy of this recent storm, separate the sheer panic from the actual facts, and figure out if, hiding inside all this chaos, smart money is actually grabbing a massive buying opportunity.
Let's start with a massive number, 473 lakh crore rupees. That's the staggering total size of the Indian stock market that got shaken up in just a single trading session. Now, for a new investor, a number like that is, well, it's basically impossible to wrap your head around, right? Think of it like a giant ocean of capital. And when a storm hits an ocean that incredibly huge, the waves it creates, they are enormous, they're terrifying, and you literally can't ignore them.
And on May 8th, those waves absolutely crashed onto the shores of Wall Street. It was a brutal, highly visible sell-off. The Nifty 50 took a solid hit, dropping 150 points to close at 24,176. But the real earthquake, that happened in the banking sector. Bank Nifty basically fell off a cliff, crashing over 736 points. Naturally, the India VIX, which you can think of as the market's ultimate fear gauge, spiked significantly higher. Financial heavyweights were just under this relentless pressure. State Bank of India collapsed nearly 7%, actually a negative 6.66% drop in one single session. Giants like HDFC Bank and Axis Bank, they were totally dragged down into this immense pressure cooker too.
Okay, let's totally flip our perspective for a second. The media headlines are out there screaming market bloodbath. That is the language of pure panic. But if we look just underneath that panic, what we actually see is normal market function. Think of the stock market like a living, breathing organism. It simply can't inhale forever. Eventually, it absolutely has to exhale. For someone new to investing, an exhale often feels like the air is being sucked right out of the room. But honestly, an exhale is just a natural, necessary release of pressure. So to figure out if this was just a heavy sigh or something way worse, we need to look at exactly what pushed the air out.
So let's look at the weather systems. There are three main forces driving this drop. Much like a weather expert tracking a storm, we can't just stare at the rain. We gotta look at the atmospheric pressure causing it. Force number one is global fear, specifically rising geopolitical tensions between the US and Iran. Imagine this like a massive earthquake happening far across the world. Even if the epicenter is thousands of miles away, it sends these invisible ripples of uncertainty straight into our local Indian markets. You know, investors, both big and small, fear one thing more than absolutely anything else: uncertainty. When the global picture gets blurry and oil prices threaten to spike, that uncertainty is always the very first domino to fall.
The second trigger is all about foreign institutional investors, or FIIs. Now, these are massive global funds. Picture FIIs as giant whales swimming around in our local market pool. In 2026, these global whales aggressively pulled out more than 2 lakh crore rupees worth of Indian equities. 2 lakh crore. Now, when giant whales suddenly leap out of a swimming pool, what happens? The water level instantly drops for everyone else left swimming. That sudden, massive exit of foreign cash is a huge reason the market bled so heavily.
Finally, trigger number three, the inherent weakness in the banking sector. You see, banking stocks carry a totally disproportionate amount of weight in our major market indices. If the Nifty is a heavy, fast-moving freight train, the banking sector is the main locomotive engine pulling the whole thing. So when that massive engine stalls out, like when Bank Nifty drops 736 points, the entire train feels the violent shock and hits the brakes, no matter what the rest of the train cars are doing. Now let's move on to the magic trick of the market. Where exactly does all that money go? When you open your app and see a sea of red numbers, your brain instantly tells you, oh no, my wealth is vanishing into thin air. But the market is actually performing a magic trick right in front of you. This brings us to a golden rule of investing. Even in market crashes, money never disappears. It just rotates. Think of capital like water. If you have a bucket that suddenly springs a massive leak, the water doesn't just cease to exist, right? It flows out, runs across the floor, and eventually puddles somewhere else. In the market, money is constantly flowing away from the areas of panic directly into brand new buckets of opportunity. And on the day of this crash, it was painfully obvious which bucket was leaking. The heavy bleeding was totally concentrated in financials. The banking bucket was visibly draining, showing big red losses everywhere. SBI down almost 7%, with HDFC and Axis Bank dragged right down with it. That was the center of the panic. That was our leaky bucket.
But here is the magic trick. While everyone was totally fixated on the banks, a few other sectors quietly, almost silently, exploded higher. Smart traders saw mid-caps absolutely surge. Thermax shot up 11%, Nuvama up 10%, Sonata Software jumped 9%. Healthcare looked really strong with Apollo Hospitals. Even Titan surged nearly 5%. And the Nifty IT index, fueled by giants like Infosys and TCS, actually bounced back and closed sharply higher. See, the money didn't vanish, it just rotated right into these new buckets.
Which brings us to the safe house, navigating fear, safety, and opportunity. When a storm like this hits, how do you actually weatherproof your portfolio? Well, market experts are laying out a super clear map right now. They're strongly urging short-term caution on the sectors taking the biggest hits, mostly banking and consumption. Those are definitely the leaky buckets at the moment. But at the exact same time, they're pointing long-term investors straight toward capital goods, pharma, and defense. The thinking is, these sectors have the deep fundamental strength to not just survive the current storm, but to act as a rock-solid foundation for massive long-term growth once the skies finally clear.
And hey, it's not just stocks. Whenever fear spikes in traditional markets, we always see a huge rush to alternative safe houses. Right now, we're seeing massive global cash flowing straight into gold ETFs, literally the oldest safe haven in the history books. But what's super fascinating is that we're also seeing modern alternatives flexing their muscles, with Bitcoin continuing to hold incredibly strong near that $80,000 level. Investors are basically diversifying their shelter, stepping outside of normal equities to protect their cash from the immediate storm. You know, markets are undeniably emotional. One single headline can cause mass panic, and the very next day, a different headline causes pure euphoria. But remember this, real wealth is rarely, if ever, built during times of ultimate comfort. It's built by understanding the mechanics of the storm while everyone else is just blindly staring at the lightning. So as we wrap up this explainer, you really have to ask yourself one vital question. Are you going to let the headlines force you to panic with the crowd? Or are you going to follow the rotation of capital and prepare for the next massive opportunity? The choice is entirely yours. Keep learning, keep analyzing, and we'll see you in the next explainer.